All right. Well, Dale, have a great interview with Bruce. I love Bruce. I'm a Bruce fan.
Yet?
I'm sorry?
Have you interviewed him yet?
I have. He's great. Bruce is awesome. So just so you guys all know, and before you go anywhere, the Wyckoff accumulation distribution patterns are probably some of the most powerful that you can find in my view. And I was not a astute study of them for most of my career, but over the last several years, I've started to pay more attention to them. I don't see them that develop that often in the markets that I follow, but when I see them, I pay really close attention. So Bruce, I'm sure, has some great setups for you. So have a great interview. Thanks, K-Man, Ryan, Stelios, and I'm even going to thank Steve, even though he talked over me today. Thank you, Steve. And Dale, thank you for being here.
All right, thank you, team. Bruce, welcome back to F.A.C.E, Mr. Wyckovian.
I'm having so much fun listening to you all that I'm like, oh my gosh, I've got to talk now.
You got to talk, and you have to share your screen. And
I'm on it.
We always look forward to what you bring to the table, Bruce. So, curious what your market discussion was. Oh, crude oil, what a very timely. Okay, power charting, and there's your mentor, and a man who's shaped your career.
40 years.
Yeah, shaped your career. When did he pass?
1934. Yeah.
Okay.
He wrote his course, his trading course, in the early 30s, and he was quite ill.
Yeah.
But he was just a great, great thinker, great trader, and he was also a really, really good communicator. And so the course is just incredible.
So many iconic traders out of that era.
He was really good friends with Jesse Livermore.
Okay.
Jesse Livermore, the only person that Jesse Livermore let into his inner trading sanctum was Richard D. Wyckoff, and he let Richard D. Wyckoff write about him, observing him trading. Cool. So they were peers.
All right.
So
all right, I just they were all there.
Great.
And there,
yes.
Can imagine all the knowledge and wisdom, and maybe this stuff, it's the era that produces these kind of people, and maybe we're in that kind of era now, and someone will have a picture of you up on their webinar 50 years from now, 70 years from now, what they learned from Bruce.
It's all I can do. I'm in the glow of being able to talk with Dale. It's like this is the pinnacle for me.
Oh yeah, I've seen who you've talked to before. So just why don't we take it away with your PowerPoint here? So
power charting is a weekly video series or show that I do on stockcharts.com. It's completely free. It's not behind a paywall. You can go to Stock Charts, go to the Stock Charts TV channel, and you can find the YouTube video or watch it live, either one. But anyway, these are pretty much the things that I talk about. I'm pretty much a pure technician. I'm a pure tape reader, as we would say in Wyckoff. And so everything I do, if it moves, if it crawls, if it does anything, I try to chart it and then analyze it. And so I don't, reasons are strictly optional when you're a tape reader. But so here I did something, this chart, which we may have looked at in the past, and I won't spend any time on it, but this is a point and figure chart. And I do a lot of, Wyckoff was really known for its point and figure analysis, and he did horizontal point and figure analysis. And this would be the study of these horizontal structures, and both on a vertical chart and a point and figure. And I did a point and figure chart on the consumer price index back to 2000. And so these are a couple of the results I got. And here you can see this initial count, which is this yellow area, gives us a count objective range 8.25 up to 1188, which would be kind of ouch. But at the time that I did this, people were like scoffing, and look where we are. And so this is 8.6. But I'm going to make a case here in the next few minutes why I think we may, because we did get into the middle of this objective range, that we may be done going up for a while, hopefully for a long while. But, you know, like I said, we just got to follow what the charts tell us.
Yeah,
and
the amazing thing is that most people would think that you could only use point and figure for things that trade. And this is a clear example that you can use them for a series of data points.
Well, and the other thing,
I've never seen them used this way, Bruce. That's what I'm saying.
And I had somebody point out to me, a friend, who said, well, you know, everything that's in the CPI, it trades. You know, markets are made in all the components. So it's like an index. It is an index. So anyway, here.
Consumer pain index.
Oh, gosh. And it's not good stuff. You know, I mean, it's like I'm really feeling the pain for everybody, including, you know, my family and so on. And you know, the gas price. I'm going to talk about gasoline in a minute too, but here, this chart, you can see this is from 2020. I did a horizontal count of crude oil at that time. And that count took us up to an area of 92 to 112. And so we actually had only three trading days in a climactic acceleration where we went above that 112 area and then immediately turned back down into this zone, which was what we would call in Wyckoff, we would call this a buying climax and a automatic reaction. And then we have been range bound ever since. We recently have thrown over the top of this area here, but have not gotten back to the top of the climax. And so mostly once this count objective was exceeded, it snapped right back into it. Happens a lot that way. And then has spent time. Now it's very possible that we're getting a reaccumulation for another, what we would call a reaccumulation confirming count. And so now look at what we have. And now with point and figure, you can get objectives. There's no better way in my mind to achieve a price objective from a structure. But at the same time, we can't tell the timing of it. We have to turn to other things like cycles, and which, you know, could very well augment this. So this could happen a long, long time from now.
Is this chart not updated? Because we did trade much lower than your last circle that you have on the chart here.
Right there, it's June 15th, and
big break, $15 break in the last week or so.
And so we continue to be range bound in here, and so I consider that actually to be good. And I brought the chart up to date. Let me clean this up. And so here you can see what has happened since. This is through the 22nd, so yesterday. And you can, I put the point and figure objectives here. You can see this yellow box area represents the area of the point and figure objectives. Attempts to get above it, another attempt on a test to get above it has fallen back in. And also is back to the trend channel line. And so it may hover around here. Wouldn't surprise me if it couldn't come back into the channel, maybe come back to this automatic reaction point. So I think that actually would be a very good thing, because we know that crude oil infects everything.
And, all right. So if we say, for example, theoretically, we break the support level of 93, 94, your AR level. What's it going to take in both point and figure and your candlestick chart to flip from it being a bullish chart to a bearish chart?
Well, we could take, partly we've had a buying climax, an automatic reaction. Those two points come at this roughly the same point in time, and that sets up the condition for a range-bound structure. We've had a test now. We can see that the quality of the advance back up into the the test of this buying climax has not been as good and has not gotten back to the highs, which is a sign of a characteristic of weakness. And now it's with, as Phil Sims would say, with great alacrity, has come back in to the structure here. So, and look at the volume coming in there, supply here. And so this is really encouraging, and this may all in fact be distribution. So let's, you know, we got to keep a really close eye on this, and maybe it can get back down to the bottom of the channel. And here that's around $82 at this time. And so I'd love to see that happen. And it would be good for everybody.
Bonds.
Be great for bonds. Well, bonds, I have a chart here if we have time. Now, what I want to do is also I want to show everybody gasoline. I just did a study on gasoline, and these are really big studies, but this is a beautiful structure, and it goes back to 2014. You can see here prior examples. I find point and figure to work really well on the energy markets. And so you can see these count objectives that I threw in here. So you could see, look at how well it picked that up. Anyway, so from here, the more conservative count, the green one, actually, now this is really wholesale gasoline prices, the futures market, not the retail market. So you can add about a zillion dollars to this number in California. And so here, this is the objective range of the green area. This is the objective range of the yellow area. Again, we can't determine the amount of time it takes to get there. But more importantly, I just want to point out, here's a little structure right here. Went up to this resistance area, long-term consolidated here, and then had a push through. Even though crude oil did not go to a new high, gasoline did, and it went to 430, and that's only one box below the objective of 440 to 5. So I would call that, you know, pretty close to a hit here. And so let's look here. This is now the daily data, and this is as of June 15th, June 13th. But this is the uptrend that we just looked at on that big point and figure chart, 430 to 480, doing just one box reversal swing trading counts. You can see they've worked pretty well throughout. And so here we are touching 430 and then having a really sharp reaction along with crude oil. And you can see this price was as of yesterday, I think 373. And then over here, you can see all I've done, same basic structure of the point and figure, just looking at more data. And I took a big count here of this accumulation that goes back to 2018, one box reversal, 10.1 scaling, goes 380 to 520 with a mid-range of 450. And look, we have gone right into that objective range, and we're turning pretty sharply. So I think for the time being that you might be able to stick a fork in the gasoline market, which would be good news too.
Right.
So
interesting.
Yeah, so that's just and then here is just a current chart of gasoline hitting the 430 objective on the
heck of a
chart.
Gap down.
Yeah, that's like very aggressive. Volume's pretty high, ease of movement down, back into the structure below the climax here in early March. And so I think that that's a sign that this, you know, Powell's getting his way.
Yeah,
Maybe
can we say what the Fed is doing is starting to work?
Exactly. And
I mean, is it all demand destruction? I know we're technicians, or could it be something else about supplies, or just it was such a crowded trade, this had to happen?
Yeah, and that, you know, it's like the old, you know, I always like to say reasons are optional, and but I do think the Fed's having an influence on this, and also you can just see the characteristics of supply coming in here and selling this market And so I think best case for gasoline is for some indeterminate period of time, we're range bound,
Okay.
and maybe more. So,
Okay.
yeah. So,
Nice looks at energy, man.
And now here, just turning to the interest rate market. So interestingly, and this chart has been my working chart for the 10-year US Treasury for a while now, back to 2021. And you can see it's just a one box reversal swing trading chart.
Yeah.
And here, this count objective went 263.40. And sure enough, look what we did is we just accelerated right up to that 340 level. And we have turned. Now, what I did, I don't have this chart up to date, but I think
because we pulled back to 313 or 312.
Thank you. Yeah. So that was the number I was kind of searching for, is like, we're right in here. And so that's a really good sign that we've turned this, which could be because of the energy market. It could be because the economy is demonstrably slowing, et cetera, et cetera. And so this is I think this is really important. And I think that it means the Fed is going to be less aggressive. That they may talk tough, but they're probably going to be a little less aggressive than raising 0.75% at every meeting like they're talking about. They don't want to do that, I don't think. This is just a yield curve chart over here. Shows the yield curve has gotten down to zero, pretty close. It's flirting with zero. This is an indication of recession. Tight money. So when you get a negative yield curve or a flat yield curve, that's tight money. And so the consequences of that is it starts to really weigh on the economy. Now, the difference between 2019, when we went to zero, look what the 10-year and the 2-year were doing. They were dropping. Rates were falling. So at that time, and this chart really was made back then, at that time, I said, this is no big deal because the rate structure is falling across the board. Look at it now, Dale.
Yeah.
It's just like, oh my God. Yeah, it's very tight money.
So what are the implications of the two different environments with the same results? Does it mean anything different? I mean,
I think I just think it means that the Fed was accommodative back here. Yield curve went to zero, but it didn't mean recession because we had a falling rate structure across. And here we have a very steeply rising rate structure. And this truly is a tight money environment, which is likely to give us a recession. And so I wouldn't surprise me if the GDP number for the second quarter comes in negative. But remember, we all have to remember that's old news. And that when we finally get the GDP number, the market participants are way ahead of that information. So here's Blake had mentioned schematics. So I'm just showing you these. I'm not going to talk about the mechanics or the specifics, but certainly go read my blogs. Those are at Stock Charts too, and read about distribution structures. You can just go back into the archives and look this one up. Here's the date of it back in 2015 and read about it. And
what time's your show on? I know they record them, but can people catch it live?
Yes, they can. It's Friday. Used to be 3:00 Eastern. I think they've moved it up, or they're going to move it up to 1:30, but Friday afternoon.
Okay, thanks, Bruce.
And then very shortly thereafter, it goes to YouTube.
Okay.
So we have about 10 minutes left?
It's as long as you want.
Yeah, Dale, you spoil
or as
me.
short, or as short as you want.
And so here,
you're the guest.
Thank you. Here is the NASDAQ 100. And so we know how it's been just bludgeoned here. And here's a count off the top. And you can see the vertical here. Now, this is through yesterday, this chart, the vertical chart. And you can see my interpretation of the structure up here. So I took this count here, counted down to the area of this initial stopping point. There was some really nice green shoots that occurred in here, gave us a swing trading opportunity and a best rally of the year there.
That was.
And then here we got another redistribution. And so
Yeah.
stair step lower, and we have fulfilled that at 11.2 to 11.4. And so we'll see whether or not it can stop this decline. And it can.
What would it take to, I know we need some X's. Would it be back above, say, 12,000, that last X before the decline, that you would have a structure, and then if it starts trading above it, would turn positive?
Good question. Here, we always are looking for a cause. So there is the makings of a cause here. And so we might be call this range bound, building something for another move. At this point, what we don't know is whether it's maybe there's a little swing trading opportunity inside of this. We don't know whether it's another distribution for another move down. We just can't tell because we don't know how bad the economy is really going to get. The energy market could be helpful, but there's, who knows. Now, let me see if I can't maybe answer that question a little bit more conclusively. Here's the S&P, and here's the distribution structure. Here is where we talked about potential green shoots. By the way, we meet every Wednesday afternoon. Ramon and we both taught together at Golden Gate University for years and years. And we do a Wyckoff market discussion every Wednesday. And you can go to wyckoffanalytix.com and see some of our recent episodes. And also you can come join us sometime. Anyway, so here, a couple things. Well, this has been my working chart. So it's a mess for really since the fourth quarter of last year, because when we had this big break, we were like, okay, this is really important supply showing up here. This could be the beginning of something really big. And so sure enough, then we had a buying climax, acceleration, throw over into at the top of the channel. We up thrusted the buying climax, tested it, and immediately failed. And look at the incredible weakness that came on the failure there. And then continued to build a distributional structure. I have another chart on this. It's kind of interesting, which I made. I made it just for you, and I will see if it works. Anyway, here's the downtrend. Here and here, throw under occurred, oversold, and so look. The other thing I want to point out, and I've studied this back to the 1800s, and this is quarter end behavior in the indexes, stock indexes, quarter end, year end. Look at this, up thrust right into the end of the year. That was all she wrote. Quarter end here, and now we have another quarter end coming imminently next week. And look at the selling. I think that there's been window dressing and selling by large institutions. Look at the gaps in here. I mean, this is just, it's like a panic. It's like a selling climax. And now we'd have to get a really sharp rally back up into here to really say that this was exhaustion selling and that we're range bound. And maybe we either, because third quarter, and not to be political, third quarter is before the November elections. And so I believe that the Fed, this is always the case, doesn't matter the party, but the Fed doesn't want to look political. And so likely in the third quarter, they're going to try to be non-controversial, step aside, and maybe behind the scenes be a little more accommodative and put
so how about a summer rally, Bruce, and then a failure?
There it is. There it is. That I think that's entirely possible. Absolutely. And so here could be that we have to build a cause of some kind for a more important move. Now here, interestingly, here's the S&P equivalent of what we just looked at with the NASDAQ. So you can see the distributional top gave a great objective count down here, traded in a trading range, built a new redistribution. and now went 39 to 3,800, but it actually has gone, I think, down to the lowest I saw at the time was 36.77.
Yeah.
Could have been lower. I don't recall, but
it may have been 40. I don't know, 50. I could pull it up, but right around there.
Right around there. And so, and from the perspective of point and figure, these are 50-point boxes. So 30, that would have been the lowest box would have been 36.50 if it went to 36.40. Okay. So, and now here, more importantly, and this is also true for the NASDAQ, bigger count, 31 columns across here. This is the whole distribution. And this count goes to 29.50, 32.50. Now, it doesn't mean you can't have an intervening rally.
Yeah.
And it doesn't mean that this is maybe the conclusion of the decline. It looks to me like we're in a primary bear market, but look at just the sheer magnitude of this distribution. And
yeah, I think that's right around 61.8 back, Bruce, from the COVID low to the high of last year.
Interesting. Yeah. And so here, I'm not going to spend any time on this. This is NASDAQ stocks above their 50-day moving average. Yeah. I love this as a breadth indicator. Lower lows in June, higher lows on the NASDAQ. So this might be a green shoot, might be. But most everything I'm looking at, you can look at data like bullish percent and other breadth data for sectors and so on. Here's the New York, new low. Now, I can only go to zero, but I mean, only 10% of stocks are above their 50-day. And so we need to see two things from this indicator. One is it starts to make higher lows. And then the other thing is it shows directionality. And I don't think we have a cause built yet for a move. And I'm not sure we'll ever get one. But I'm just pointing out that that would be the things that we would look for in Wyckoff land. And then here, kind of a fun, interesting chart. I've been keeping up for a long time. This goes back, this really comments Blake was making about the uptrend of this really historic move. The amount of Fed easing that took place from 2009 to the present is unbelievable. And still the Fed could be arguably easy here. So look what we've done.
We're still at negative rates.
It's still at negative rates. And there's no way possibly that they could say that Powell is like Volcker. Volcker was, he got rates above the inflation rate, and that broke the back of inflation.
He did it twice, according to Steve Volge. My memory's foggy. I traded through that. I don't remember a start and stop. Do you? Where Volcker went through a tightening cycle and then eased up and then went back to it, and that's what finally did it?
I guess I'd have to go back and look at my data, but
well, Steve Volge, he's a very good market historian. So
I'm sure he's right. If he
and so maybe that's what we get here. The Fed starts getting nervous and they pull back a little bit, and then they have to go at it again.
It took all of the 70s for them finally to get serious at the Fed about tightening, because they just kept ramping up inflation throughout the 70s. And that's
it took all of the 70s and 80s for me to get serious about life. So it took me longer than the Fed. All right.
That's
70s,
funny.
college days, Bruce. So
Oh
God, I wish I was back in the dorm.
I wish I could remember those days.
Anyway, great presentation. Best way for people to, get a hold of you, ask questions, have a schedule of when they could see you or sign up. What's the best
they
way?
can go to Twitter here, message me, at RD Wyckoff. They certainly can come to Stock Charts and see some of that content. And I'm going to talk about this chart this week on power charting. So I won't go into it, but I'll just put that out as
all right. Good tease.
This is 2000 to 2002-3, and we talk about we unbundle this bear market, and then here is the chart we just looked at, and look at the the parallels in the relationship of the distribution. It's
Yeah.
it's really amazing. And
Yeah,
Dale,
Fractal. Yes.
Fractal, and thank you so much. It's always great to hang with you.
Yeah. You know, nothing better than compelling information and having a good time presenting it. And
Absolutely.
so, you host your show, Bruce. Respect here from us here at ForexAnalytix, and appreciation that you come here every 3 months or so to, share what's happening on your radar.
Thank you so much, Dale, and it's just great to be with you all.
Okay, I'll get a hold of you on Twitter, and so we could talk again in the fall, see how things play out from here.
Sounds great.
All right, my trading warrior brother, Bruce Fraser, everybody.
Thank you, Dale.
And
thank you, everyone.
I really appreciate you being here. Guys, you could join the team in 13 minutes for the morning edge, and we'll see everyone tomorrow for TGIF. Thank you, Bruce. Always good to hear your voice. I'm a fan, rooting for you. Adios, everyone. You're welcome, Laura, Michael, Stephen.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.